DeFi arguably represents the greatest investment opportunity of this decade. Total value locked in DeFi protocols has risen from under $1 billion just a year ago to over $50 billion today. With that in mind, in this video we're going to be going over how you can put your idle crypto assets to work using a DeFi protocol that is revolutionizing money markets, and that's Compound Finance. We're going to go over how Compound works, and then we're going to jump into whether Compound's governance token Comp represents a good investment opportunity today. So with that, let's get right into it. To start things off, I'm just going to provide a broad overview of the Compound protocol. Compound is a permissionless application built on Ethereum that uses asset pools to create efficient money markets for Ethereum-based assets. Suppliers of capital, in other words lenders, commit their capital to these asset pools from which borrowers are permitted to take out over-collateralized loans from. The interest rate that is paid by borrowers and subsequently earned by suppliers is algorithmically determined based on a relationship between the supply and demand of assets held in a given pool. A reasonable way to conceptualize these asset pools so that you can draw some sort of parallel between the traditional financial markets and these asset pools on Compound is that these asset pools essentially replace the role that a bank would play in traditional lending markets. Banks pool together deposits from their customers, and then they use these deposit pools to give out loans to creditworthy individuals and businesses. After paying for expenses and returning some capital to shareholders, the remainder of the profits that they make from giving out these loans are returned to the depositors in the form of a savings interest rate. Now, obviously, this is an extremely inefficient system for the depositors specifically, and that's why the Compound protocol has replaced the role of the bank with these asset pools that leverage efficient smart contracts to govern the behaviors between lenders and borrowers. So I think that that's a useful conceptualization of the role that these asset pools play, but the actual mechanics of how lenders earn and borrowers pay interest is quite different from traditional financial markets. Now, there are three primary concepts that we're going to cover in this video, which I think are really important to understand how the Compound protocol works. The first is how lenders earn and borrowers pay interest. The second is how interest rates are determined on the protocol. And the third is how the protocol protects lenders from different types of risk. So let's start with the first one. When a lender commits capital to a particular asset pool on Compound, they are given an ERC20 token that represents their proportional ownership of the assets held within that pool. And on Compound, these ERC20 tokens are called C tokens. So, for example, if you deposit Ethereum into the protocol, you're given C ETH in return. If you deposit USDC, you're given C USDC in return. Now, interest is earned and accumulated on the protocol with every new block that is mined on Ethereum, so this happens roughly every 12 to 15 seconds. Now, rather than the protocol paying lenders directly every 12 to 15 seconds, interest is accumulated by the asset pool and represented in a lender's account through an increasing exchange rate between the C tokens and the underlying asset that was committed to the pool. So I think the best way to understand this is through an example. Let's say that you deposit 1 Ether into the Ether pool and you're given 1 C ETH token in return. Let's say that the APY on the Ether pool is 10% and you hold on to that C ETH token for 1 year. At the end of that year, that 1 C ETH token is still going to be 1 C ETH token, but instead of being redeemable for 1 Ether, it's going to be redeemable for 1.1 Ether. And this is how interest is earned and accumulated by lenders on the protocol. The longer that you hold on to C tokens, the more of the underlying asset they're going to be redeemable for when you do choose to redeem the underlying asset. It's for this reason that if you want to earn interest using the Compound protocol, you don't actually even need to supply assets onto the protocol. You can simply go and buy a C token on a secondary market through a decentralized exchange. Now, on the borrower's end, the mechanics of how the borrower pays are the exact opposite. A borrower must first deposit some collateral into the platform by supplying some asset, after which they're able to take an over-collateralized loan out of the borrowing markets. But unlike a lender who owns a C token, borrowers have to pay back C tokens at some point in the future. So the longer that a borrower borrows a specific asset from a pool, the more of that asset they're going to have to return later in the future when they choose to pay back their loan. And it's the mechanics of this borrowing and lending that makes the Compound protocol so much more efficient than traditional financial markets, because rather than lenders and borrowers having to manage multiple streams of income, borrowing and lending becomes as simple as just tracking the value of the C tokens that either you owe or that you own. Alright, so now let's move on to how the interest rates are determined by the protocol, and this is also another really cool aspect to how the Compound protocol works. Like I mentioned earlier, interest rates on the protocol are determined by an algorithmic relationship between the supply and demand of an asset held in a pool, and on the protocol it's represented by utilization rates. The utilization rate represents what percentage of the assets held within a pool are currently being loaned out by the protocol. As the utilization rate of any given pool rises, so does the cost of borrowing an asset from that pool, and vice versa. Now you'll notice that for some pools, like the Ether pool, the relationship between utilization and interest rates is a gradual rise, but when you look at other pools like the USDC pool, you'll notice that there is a clear kink within the interest rate curve. And the reason why is because if liquidity gets too low within any given pool, represented by a really high utilization rate, then this means that if a lot of lenders want to take back their capital, they're not going to be able to because there's not going to be enough liquidity within the pool to allow them to withdraw their assets. So in this sense, the relationship between utilization rates and interest rates balances supply and demand, but more importantly, it protects lenders from liquidity risk. So if you're going to be borrowing or lending using the compound protocol, something really important to be watching is utilization rates. So now this leads us really nicely into the third and final concept we're going to be talking about in this video, which is what the protocol does to protect lenders from various risks. Now the relationship between utilization rates and interest rates is one of the things that protects lenders from liquidity risk, which is the risk that there won't be enough liquidity in the pool to withdraw their assets at any given time. Another risk is the risk of default. And one of the ways that the protocol has essentially eliminated default risk is through overcollateralization. Now, overcollateralization simply refers to the fact that borrowers can only borrow from the protocol less than the amount that they have supplied to the protocol. The amount that a borrower is allowed to borrow from the compound protocol is dependent on the collateral factor of the asset that they supplied. The collateral factor is a number between 0 to 1, and it represents what percentage of a supplied asset a borrower is allowed to borrow against. So for example, the collateral factor for the Ether pool is 0.75, which means that if a borrower supplied $100,000 worth of Ether into the protocol, they would only be permitted to borrow a maximum of $75,000 worth of another asset from the protocol. If a borrower ever does exceed their borrowing limit, then the protocol has a liquidation feature built in, which will reduce the borrower's position until their position is below their borrowing limit, and this is what protects lenders from default risk. Now, if you are a borrower, you should also keep in mind that you probably shouldn't be borrowing the maximum amount that you're able to, because your position will pretty much immediately go into liquidation, since your account is going to start accumulating interest immediately. Now, the second mechanism that the protocol is designed to protect lenders from default risk is by including a reserve factor. Now, reserves in any given asset pool represent a portion of interest that has been earned and accumulated by the asset pool and has been retained and set aside by the protocol to protect against any potential defaults that occur on the protocol. So you can kind of think of the reserves of any given pool as insurance. So for example, the reserve factor for the Ether pool is 20%, which means that 20% of all interest that is paid by borrowers is taken and set aside as reserves for the asset pool. This also means that the interest earned by suppliers of Ether is reduced by 20%, but it also protects these lenders from the possibility of defaults that occur within that lending pool. Now, an important thing to note about the comp tokens, which is going to be important when we get into the investment thesis, is that because the comp token is a governance token, and eventually the compound protocol is going to be entirely decentralized and governed by comp token holders, the comp token holders can decide what to do with the assets held in reserve. Now, we'll circle back to exactly what this means in regards to the investment thesis, but that's something that's important to note, which is that comp token holders essentially own the assets held in reserve. So that does it for the explanation of how the compound protocol works, and hopefully after that you have enough information that you can actually start using the compound protocol to put your idle crypto assets to work and start earning some yield on them. And even further than that, maybe you want to start using the borrowing markets and start borrowing assets from the compound protocol and putting those borrowed assets to work on other DeFi protocols, like maybe becoming a liquidity provider on a decentralized exchange, or maybe becoming a liquidity provider on something like KeeperDAO. Now, we won't get into those strategies in this video, but there are definitely some really interesting opportunities available in the DeFi markets that you can take advantage of leveraging Compound's borrowing markets. Now, let's jump into Compound's governance token Comp and take a look at whether it represents a good investment opportunity today. Now, as it stands today, there are currently 5 million Comp tokens in circulation with a maximum supply of 10 million tokens. Now, the majority of this future dilution is going to be coming from Compound's reward distribution program, which currently has around 3.7 million tokens left to be distributed. Now, while this distribution is dilutive for current token holders, it also represents a really strong competitive advantage over other DeFi lending protocols like Aave and Compound, because it allows Compound to offer lenders a higher net APY, and it also allows Compound to offer borrowers a lower net APY. What I think this is going to do is it's going to allow Compound to attract a greater proportion of future growth and value locked on DeFi lending protocols, and it's going to allow Compound to outpace the growth of its competitors Aave and Maker. However, when we take a look at the relative valuation of Compound against its peers, this competitive advantage isn't reflected in the valuation at all. In fact, Compound has the lowest market capitalization of both Aave and Maker, and as a result, it has the lowest market cap to total value locked ratio of all three. So from a relative valuation standpoint, Compound appears to offer the best value out of the three protocols. But what about from an absolute valuation standpoint? It's definitely a challenge to try to value a protocol that is growing at such a rapid pace, but the way that I've gone about valuing Compound is by valuing the reserves held by the protocol. Like I mentioned earlier in the video, comp token holders own the assets held in reserve, and they get to decide what to do with those tokens, whether that be letting them sit in the asset pools and collecting interest, or maybe paying comp token holders through something like an airdrop or maybe a buy and burn mechanism. This is all going to be dependent on what the governance decides to do with these assets held in reserve later in the future. So it's hard to say exactly how this value is going to be repaid to comp token holders in the future, but we can use this value of assets held in reserve as a way to derive the intrinsic value of comp tokens. Currently, there are $24 million held in reserves on the protocol. Now, when you compare that to the total market capitalization of Compound, which sits at around $3 billion, it seems really insignificant. It means that about 1% of each comp token is backed by value held in the reserve. However, the growth of total value locked on the protocol has more than tripled over the last 4 months, and I think that it's reasonable to assume that the growth in total value locked on the protocol is going to continue to grow at a compounded annual growth rate greater than 100% for the next 3 to 5 years. Now, because the value of reserves rises proportionally to the amount of interest paid by borrowers on the protocol, this means that the value of future reserves should grow proportionally to the amount of value being borrowed on the protocol. Now, if we apply the same compounded annual growth rate of 100% to the value of the assets held in the reserves for the next 5 years until 2025, and then we discount the value of these reserves by a 10% annual discount rate, what we get is a net present value of around $1.1 billion for the reserves held by the Compound protocol. Now, with these assumptions, not only does comp tokens seem reasonably valued and the valuation starts to make a little bit more sense, but it points to the possibility that comp tokens are currently being undervalued by the market. Now, of course, the most important thing here is to be confident in the fact that the assumptions used to value these reserves are reasonable. And most specifically, the Compound will be able to grow the value locked at a compounded annual growth rate of 100% for the next 3 to 5 years. Now, here's my reasoning on why I think that this is a likely outcome for the protocol, and you guys can tell me in the comments below if you think that my reasoning is off or if that I'm potentially missing something. Now, currently there's around $7 billion being borrowed on the protocol. And if Compound achieves a compounded annual growth rate of 100% in this value, the total value borrowed on the protocol is going to reach around $112 billion by 2025. Now, when we compare this to the value of global debt markets, which are around $120 trillion, this means that around 0.1% of global debt markets will have to be shifted over to the Compound protocol. Now, while 0.1% might seem pretty insignificant, this is no trivial task for Compound, and it's going to require some pretty significant advantages to attract that much capital to shift from traditional debt markets over to DeFi lending markets and to the Compound protocol more specifically. Now, I think that Compound has some significant competitive advantages over traditional debt markets, and primarily those are the fact that debt servicing costs on Compound are significantly lower than that of traditional financial markets because intermediaries are replaced with smart contracts. And on top of that, the Compound protocol has been able to virtually eliminate default risk through overcollateralization and liquidation policies. Now, I think that these two advantages are reason enough to anticipate billions of dollars flowing onto the Compound protocol. But then when we also take into account the fact that the crypto markets as a whole have been growing at a compounded annual growth rate of over 100% for the last 5 years, we can anticipate that just the general growth of crypto markets is also going to contribute to the growth of value locked on the Compound protocol. Now, this puts Compound at a really unique crossroads of two really high growth trends, which is the gradual shift of capital from traditional financial markets over to DeFi lending markets, as well as the general growth in the crypto markets as a whole. So this is why I think that my assumptions of 100% compounded annual growth rates for the next 3 to 5 years for Compound are reasonable assumptions to be making. And for this reason, I think that comp tokens are currently undervalued in the market, and I think that they represent a really great growth opportunity. Now, of course, if you're going to be investing in comp tokens, you should definitely be spending some time and looking through these assumptions to see if it makes sense for you to be paying for this potential growth in Compound. Maybe it doesn't make sense with your portfolio to be allocating any of your assets over to Compound, so this is something that should be considered before making an investment decision in Compound. And if maybe you decide it doesn't make sense to reallocate any of your assets over to Compound, then what you can do is simply use the Compound markets, lend out some assets or maybe borrow some assets on the protocol, and earn comp tokens as a reward for using the platform. So that does it for this video. I think it's a good time to mention that I am not a financial advisor. These videos are purely for entertainment and educational purposes, but I hope that you guys enjoyed, and I look forward to seeing you all in my next video.